Either there's these sources of information that really know what they're talking about, have deep subject matter expertise, but there is a bias or a, mixed incentives there. And then there's a set of resources that I think are, nuanced, complex, unbiased, but really tended not to focus on very high net worth or ultra high net worth questions. I said, okay, I want this community to exist, so I'm going to set up. Initially it was just a glorified Slack channel with a dozen of my friends. That ended up being that they would refer their friends, oh, my brother, this guy on my board, my co-founder of this company. And so really without doing outbound marketing, we have ended up growing from a dozen people to about 6,000 members today.
Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back on the Rise podcast listeners. Thank you again for jumping into yet another episode. I've got another amazing guest as I do always. I've got Tad Fallows. Tad, welcome to the show.
Hey, thank you so much for having me, Jeremy. Really excited for the conversation.
Yeah, likewise. Looking forward to chopping it up with you. So Tad founded a company by the name of Long Angle as a community for entrepreneurs, executives, and investors to share unbiased information and access to institution-grade private market investments. Tad, you're kind of like the resource in somebody's hip pocket that they can go to be able to determine whether or not they're making a risk-adjusted investment decision. So before we kind of, jump into, what you're focused on today, I would love to learn a little bit more about maybe your background, your journey, in the space of investing and, really what you're focused on today.
Yeah. So my background is I'm a multi-time entrepreneur. I briefly worked in consulting out of college, but then quickly discovered that I was more interested in running my own thing. So my kind of path to investing and path to gain significant assets was I started a software company and in the medical research space. I bootstrapped that for about 10 years, got to about 100 employees, and then we sold it to a strategic acquirer. And that was what then led me to start Long Angle, because I went on one day basically adding 2 zeros to the net worth. And while I'd always been a personal finance hobbyist, there are now a whole bunch of new questions, whether that was things like estate taxes, things like access to more sophisticated private market investments, travel, probably most challenging, raising kids with wealth. I had a 0 and 3-year-old at the time and saying, okay, how do I make sure wealth is actually an asset to them and not a liability? And that's what led my partner and I to start Long Angle, where we said, okay, there's a lot of the information that applies the question, hey, how do I fund a 529 plan? How do I max out my 401k? There's a lot of good, generally available information on there. When you get to these things like, hey, is there a case for private placement life insurance? How do I think about estate taxes? How much umbrella insurance do I need? It felt like all the advice was coming from Credit Suisse and Goldman Sachs, and we wanted to get that advice from people who were not trying to sell us anything and were in the same situation. So that's what led us to start Long Angle. And actually, to clarify, it's not just about private market investing. Most people are really just joining because they want a community of peers in the same situation, which for us is generally people who've created maybe $5 to $100 or $200 million of investable assets, who are in that situation and are just looking for unbiased advice across this whole spectrum. So some of that is investments of, hey, how do you think about crypto? How do you think about emerging markets? What's a good private equity fund? But then a lot of that is these other kind of, less tangible, or maybe not less tangible, but less financially oriented questions. And that is if any of your members think it sounds interesting, there's no membership fees. So we interview and vet everybody, but we don't charge for membership. So that's kind of my professional journey. Then happy to talk more about, the kind of within the investing aspect assets there, what I've learned and what I'm finding interesting right now.
Yeah, no, this is fascinating. And I appreciate that. Your journey is not not a lot different than mine. Maybe you kind of walked away, from your professional career with an extra 0, from what I did. But, that was really my, genesis and my story too, was really, build up a nice W-2 income, use your income to invest in alternative, investments, build up enough of a book of business there, diversifying in alternatives and in Wall Street to get to the point now where I could start to shift and really shift focus into educating, creating a community, and really offering that unbiased, opinion to others. So really appreciate your kind of background and story there. So maybe you can just unpack for us a little bit more, in terms of, what really inspired you, to create this long angle community, and what gap did you really see, prevalent in the marketplace, amongst successful entrepreneurs and executives alike?
Yeah. So, the gap was really one that I felt personally, which was I felt like either there's these sources of information that really know what they're talking about, have deep subject matter expertise, but by and large, there is a bias or a, mixed incentives there. And I just find it, the classic don't ask your barber if you need a haircut, don't ask the life insurance guy if you need life insurance. And I find it not particularly valuable to have an advisor where I then have to double check and say, well, what's his motivation? Is Jeremy saying I should do this because he wants to get the carry, or is he saying I should do this because it's really in my best interest? And then there's a set of resources that I think are, nuanced, complex, unbiased, but really tended not to focus on these questions that are more very high net worth or ultra high net worth questions. So that was what I felt like was a missing gap, and really it was out of personal interest that I said, okay, I want this community to exist, so I'm going to set up. Initially it was just a glorified Slack channel with a dozen of my friends. That ended up being that they would refer their friends, oh, my brother, this guy on my board, my co-founder of this company. And so really without doing outbound marketing, we have ended up growing from a dozen people to about 6,000 members today.
Yeah, that's great. And I think you're going to resonate with what I'm about to say here. And I'd love to get maybe more of your, feedback on this. But one of the things that I see as really a tragedy, in our country today is this lack of financial literacy. Most people's financial literacy is about as far as whatever their financial advisor tells them, maybe what their parents told them growing up, maybe something they learned, in high school or at a university, or maybe whatever their friend Brad tells them. And usually their friend Brad is going to tell them to take a look at the next new shiny, object, meme stock or something like that. So maybe you can kind of, let our listening audience know a little bit more about kind of, that statement that I made, and really what your, membership group or your group is looking to do to solve for that.
Yeah, I think it's a fantastic point. I would say one advantage a lot of our members have is often either as an entrepreneur or an executive, somebody working in finance, they tend to get a baseline level of exposure to these financial principles. You can't build a business with 50 or 100 employees without understanding something around finance, something around HR, maybe if you're Steve Jobs and a true product genius, but in general, they get some of this exposure there. And, I'll say one thing that's interesting is that you said a lot of people get their advice from their financial advisor. If you ask a typical wealth manager, hey, could one possibly manage a portfolio of 10 or 20 or $30 million independently and without a financial advisor? I think they'd tell you that's wildly irresponsible. But one interesting thing is we know, because we've run some surveys on this internally, about 2/3 of our members totally self-manage their whole portfolio. They say, you know what, maybe I'm an engineer by background or a business person. And I realize that 1% a year, particularly if somebody's on the younger side, let's say they're 40 and they put together this $10 million portfolio, they say, well, that's going to cost me 100,000 a year for the next 40 or 50 years. That's going to take away half of my lifetime, what I'm going to be able to leave to the next generation. So I think that's one interesting thing, is that a lot of people, I would say, feel this, I don't know if it's a requirement or an interest, probably a little bit of both, to figure out how to do this themselves, because they take the opposite tack and they say, hey, at $30 million, it's irresponsible not to learn how to do this. Maybe I do hire somebody else to help me, either because I don't have time. I want, my spouse to have somebody they can rely on. I want some, coaching here. But they're very active co-pilots in this. I think they feel like it's irresponsible to hand that much money to somebody else and not be an educated consumer. And I think that's really the right way to look at it. There's some markets, like if you look at the public stock market, where there's great infrastructure in place. As much as any of us can criticize the government regulation, I think the SEC does a fantastic job of making sure there's a level playing field, equal information. And so you can basically just randomly pick stocks and you're going to do fine because the market's pricing them appropriately. But as soon as you move outside that, whether that's a wealth manager and you just pick your buddy Brad and say, hey, Brad, manage my money, or whether that's you look at stuff like private equity funds or real estate funds, you're just going to see such a big dispersion of results from the best ones are excellent, the worst ones are terrible. And if you're not, sort of like within real estate, you can't just tell your GC, hey, here's a blank check, build the house. Even though I'm not a GC myself, I got to be there every step of the day of the way. I got to be going there every day or every other day to look at stuff. And so I think it's the same thing in wealth management, that if you're not a educated, active consumer, you're not going to get where you want to go.
Yeah, no, you're definitely drilling down and dialing down on something important here. And I just want to make sure my listening audience understands, that in the marketplace today, and this is true in probably a lot of different areas of life in general, but there's this massive disconnect when it comes to investing between perception and reality. Okay. So I'd like for you to maybe unpack for us a little bit more about, kind of how do your group's investment strategies differ from what most people think the perception is about what wealthy people actually do. Does that make sense?
That's a fantastic question. I'll leave aside the comment I made that most people assume that they all have wealth managers, and that's just not true. And up to you to pick if you want it. But there's also, I think, this perception that, quote, the classic portfolio is a 60-40 portfolio. So you got 60% stocks and 40% bonds, and maybe you've got some real estate in there as sort of a third asset class, but we'll leave that aside. You're 60-40. In practice, we do, as I said, a lot of internal benchmarking surveys just to let our members say, hey, what can I learn from my peers? How do I compare? There is almost no bond exposure. It is maybe 5% in bonds. So it's about 50% in public stocks like you expect, only about 5% in bonds. And then you've got this big other 45% into other things. And those are much more in the private market. So maybe 20% that's in real estate, but then you got about a third of that in what are called private markets. And so that basically means either ownership of private companies. So that's like venture capital investing or private equity investing, or it can be investments in all kinds of other somewhat more esoteric asset classes like oil and gas, like litigation finance, or actually funding lawsuits, like hedge funds where they're doing this sort of high frequency trading, music royalties, all kinds of things like that. So I think there's much more of that private market investing and much less on the bond side than you might expect from a, quote, traditional 60-40. And I think just to share the rationale behind that, the idea of the 60-40 is that, okay, your bonds are going to return less in the long term than stocks, unless we go through another Great Depression or become Argentina or something. But odds are that your equities are going to outperform if you're looking at a long period of time. Tomorrow, I have no idea, but 30 years from now, I have a very good idea that stocks will outperform. But then, what you see is the reason to have those bonds is to dampen your volatility. But I think a lot of your, wealthier folks say, hey, I care less about exactly how smooth this path is and more about, how steep this path is. And so if I know 10 years from now, I'm going to have more money following this path, I would rather follow that path, even if it's a bumpier ride along the way. But then what these other, so you could say, well, then just put it all into public stocks. But the reason they have these other things like oil and gas, litigation, finance, music royalties, is they have similar expected returns, but less correlation. And so I'll say, okay, I'm going to get a smoother path, but I'm not going to smooth it by just lowering my return with bonds. I'm going to smooth it by having these less correlated assets that are all independently high expected return.
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in these large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, you can go to our website and set up a call with our team.
As you were kind of talking there, I was also thinking about, the tax benefit side, of different types of investing strategies. And at the time of this recording, we're kind of at the beginning, of the fourth quarter here. So the clock is ticking, in terms of what, high net worth investors, can be doing to influence their 2025, tax return. So maybe you can kind of comment a little bit more about, some of the things that you're seeing, today that other high net worth investors are doing, or maybe you're doing yourself to really kind of position themselves well, as we really skirt towards the end of the year here?
Yeah, another great question. I'd say a couple things on that. One is if you're looking for a legal and ethical way to avoid taxes, you're on a real estate podcast. That is 90% of the juice of legally and ethically avoiding taxes is real estate. I don't think there's any other asset class that gets these kinds of benefits. And whether it's right or wrong on public policy, that clearly is the policy. So if that's something you're looking to do, you found most of the opportunities there through 1031 depreciation, all that kind of stuff. The other thing which may give a lot of your customers comfort is I've spoken one-on-one with 1,000 plus of our members. 90% of them feel like they're the one sucker paying all their taxes at a certain, somebody's got to pay the bills. And if you make a lot of money and have a lot of money, there's not a lot of ways to avoid that, again, other than real estate. One thing that's interesting is there are a set of people, and I would say, thankfully, it's not a real big set within our community, who are really dead set on finding some way around it. And one thing I'd say to really watch out for is just because someone's a CPA and says, oh, yeah, this is a perfectly, up and up way to do it, that does not mean it's actually an appropriate way. So I have had, more than a handful of members come to me and say, hey, love your second thoughts here. I've got a CPA pitching me this thing where I'm, buying cantaloupe seeds and freezing them for a year and donating to Haiti and stuff like that. And, it all comes down to, okay, you're paying $1 for something and then you're telling the IRS it's worth $5 in your donation. And, they've figured that one out. It's not going to pass muster. And it is not an excuse to say a CPA told me so. The IRS is still going to come after you and say, okay, maybe you're not going to jail because you didn't come up with it, but you're going to owe all the taxes you did plus a whole bunch of penalties. So, I have unfortunately seen more than I would like. And if it looks too good to be true, it probably is.
Yeah, no, I appreciate that. And good analogy there on the cantaloupe seeds. I was thinking to myself, I'm not a big fan of cantaloupes, but I wonder if I could deploy that strategy with maybe strawberry seeds or something like that. So really appreciate that, Tad.
And that was an actual example. That was not me making up frozen cantaloupe seeds.
Yeah, no, I totally believe it. I think it's important that people really, get a second opinion. I mean, oftentimes people will do that, as it relates to the feedback they receive from a doctor. So maybe why not, from a CPA or even a financial advisor, for that matter. So, how do you evaluate, or maybe how does your group evaluate, whether an opportunity is truly quote unquote institutional grade versus just dressed up with a bunch of marketing polish?
Yeah, that's a fantastic question. I think a few things. One is really look at who you are investing alongside. If their investor base, first, if they won't tell you, that's a sign it's not institutional grade. You go to any institutional grade one and they'll say, okay, well, it's the Duke endowment and it's the Cal endowment and that sort of thing. So if they won't tell you, that's a big red flag. Assuming they do tell you, are you investing mostly alongside what they call pejoratively retail investors? So is it doctors, is it dentists, et cetera? Or are you investing alongside endowments and pension funds and other institutionally operated funds? And the reason that really matters is not that, hey, the guy running that is not necessarily any smarter than you are, but that's his full-time job. And they are much more careful on these small terms. What I was saying about private markets versus public, what can kill you is the small terms. Again, to put in real estate terms, if you look at some sponsors, there is just this Chinese menu or this laundry list of, okay, it's our acquisition fee, it's our financing fee, it's our debt collection fee, it's our refi fee, it's our, whatever fee. And all those things really add up over time. And then you've got ones who have much cleaner structures of, hey, it's a 2 and 20 or it's a 1 and 15 or whatever it is. And it's not this waterfall, well, above 20, I get this, above 30, I get that, above 40, I get this. And so, as a individual investor like you and me, we only have so much time to be, analyzing that stuff. And we also have limited leverage. If I'm going to write $100,000 check, they're not going to change their fee terms for me. But if I am the Yale endowment and I'm going to write a $500 million check, you can bet they're going to listen to me and I'm going to negotiate fair terms. So a big thing is just literally if you're investing alongside institutions, then by definition, you're an institution caliber fund. And then in terms of the other characteristics, as I said, fees is a big part of it. And then probably the other thing is just scale, where you want something where the track record is there maybe on fund 3. I think that's often a good sweet spot. Because if you're in fund 1, you're just buying a blank box. It may be great. It may not be. If you're in fund 10, they're probably now with billions of dollars of AUM and whatever arbitrage opportunity they have is kind of compressed. But you're a fund 2, 3, 4, it can be kind of a sweet spot. And similarly, the AUM size, assets under management, if their fund is in the, mid, say 500 million to a few billion, it's a good combination of much less likely to have fraud, much less likely to have the key man risk. The guy gets hit by a bus and now they're out of business, but not so big that there's no edge left there. So I would say that those are some of the common characteristics.
Yeah, no, that makes sense. I'd like to get your feedback on something else and kind of drill down on what you're saying here. I know the cliche saying goes, you're investing in the jockey and not the horse. So I'd love to know how you and your group maybe are evaluating, investment opportunities based upon, really the key principles and their ability to effectively lead an organization of others, right? Creating a positive culture, casting vision, right? Executing, attracting best in class talent, which becomes a part of the team who's ultimately responsible for carrying out, the said business plan, right? So just kind of curious to know your thoughts on that.
Yeah, no simple way to do it, right? I think the easiest thing is to look at the track record and say, okay, what kind of returns have they put up in their previous funds, or maybe the guys who are running it, maybe this is their first time together, but they've worked previously. So look at what they've done. It's hard to fake that track record. Um, and then having those one-on-one conversations with them, and just a lot of it is how transparent are they too. Somebody tells you, hey, there's no weaknesses, there's no holes here, this is a guarantee. Then you just get a sense of, well, I don't know what the weaknesses are, I don't know what the risks are. So I think the best ones will tell you either, hey, it's relatively low risk, but it's relatively low return. Or, hey, yeah, we're going to try and get you a 20-25% return. But here's the things: if interest rates go through the roof, if there's another trade war, that's where we're going to suffer. And so I'd say those are probably a couple of things that I would look at there.
That makes total sense. When I think about evaluating an investment opportunity, I kind of put three types of potential risk factors out there that I'm really trying to mitigate for or solve for. I'd like to know if you have any additional ones or what maybe your thoughts are on these three. But the three main risk factors that I look for as an investor are operation risk, execution of the business plan risk, and then market risk, right? Are there any other risk factors that you and your groups, look at outside of those three?
Yeah, I mean, I do think that you have to look at the fraud risk, for lack of a better term. Not that this is universal. You could trust people in general and you'll probably be fine, but it is a non-0%, let's call it 5% of people who are just not telling the truth. There's the Bernie Madoffs, there's the FTXs. Those are the really big ones. The smaller you get, the more of those you are. So there have been ones where I just ultimately don't end up with confidence that I believe what they're saying. And, so I think that that's something else to look at. There's a lot of ways to mitigate it. If you're talking with your college roommate, maybe he's not a real sophisticated operator, but you probably have a good sense of whether he's going to defraud you. So that, and then there's ones again where you've got third party audits where if you got a team of 50 people, there's less likely to be fraud. There's a lot of ways to skin that cat, but I would just think about it.
Yeah, no, that makes total sense. I say this all the time that there's a lot of people that I trust in my life, but there's a lot of people, those very same people that I'd never trust with $1 million of my own money.
Yeah. Trust but verify.
You got it. So I'd like to maybe have you kind of let our listening audience know a little bit more about, what's your own personal definition of financial freedom, and what are you seeing that maybe other high net worth investors or entrepreneurs are getting wrong about their quote unquote nest egg number?
Yeah. So my personal definition, and I'll say that I'm probably different from other folks in our community on this. I personally focus on the passive cash flow element of it. I think all of the math will tell you, okay, 4% of your portfolio, you can spend that each year and you're going to do fine. I don't feel as comfortable with that one because if the market tanks 50%, I'm not going to be comfortable spending what I was before if it's not passive cash flow. So I really like that. And for me, a lot of that comes from rental real estate. I've sort of accidentally ended up with a big portion of my portfolio. Really, as I've moved houses, I kept the old one and rented it out. And that has turned out to be a pretty strong cash generation machine. So for me, it's does my passive cash flow cover everything I want to do? And I'll be candid, I'm not at that position today. If I say everything I want to do, it's well, if I'm not working, I want to take my wife to Paris for the weekend. If she wants to go shopping for handbags, we're going to go shopping for handbags, etc. Maybe we want to buy a place in Paris, we'll buy the place in Paris. I'm not there today. But that for me, that would be, real financial freedom. Just whatever I feel like spending is passive cash flow. That doesn't mean I need it, but that's, truly financial independence for me. In terms of how people set their number, and I would actually broaden this one, the biggest mistake I see, and I'm guilty of it as much as the next person, is getting to tactics before you know the objectives you're trying to go to. So I was listening to this fascinating talk from an estate tax attorney where he was asking people, okay, how many of you have your trust docs in place, an irrevocable trust, all these different entity structures, a slat, a grat, et cetera. And, half, 2/3 people have a pretty sophisticated plan in place. Then he was saying, how many of you have defined what you're trying to accomplish? And it was literally zero people knew what they were trying to accomplish. They were just going after it. And so similarly, for my investments, well, I don't know exactly, what my number is. I don't care. I don't know exactly what my risk tolerance is, but I like this investment and I'm going to invest in it. And again, I am as guilty of this as the next guy. So I don't mean it as a criticism, but I think all of us could probably benefit from a little bit more introspection on where am I actually trying to go before you get to the fun part of how am I going to get there.
Right. Yeah, no, that makes sense. And plus the goalpost is constantly moving, each and every year because of the inflation monster. I remember when I was a kid, I thought to myself, man, if I could just have $1 million, I wouldn't have to work the rest of my life. And, then I got into college and that number was 2 million. My young professional days, it became 3 million. Now in my kind of mid to late, 40s, I don't know, it's probably north of 5 to 7, 10 million, based on my current, lifestyle. So it's just an interesting, concept that everybody gets drilled down on what this nest egg number is, but that goalpost continues to move year in and year out.
Well, I can tell you your number is exactly twice what you have today. And the other interesting thing, I was talking with Morgan Housel, who has this psychology of money book, and one thing is he was saying he has this quote end of history fallacy where I'm in my mid 40s, and if I look back to what I really valued in my mid 30s and what I wanted to accomplish, or what I value in my mid 20s and what I want to accomplish, it is different today than it was then. And that's not a knock on me. That's just like human. I evolve, and same thing. Everybody, what they want now versus 20 years ago is different. But the fallacy is that you think, okay, I've reached the end of history. What I want now is what I'm going to want in 10 years, or what I'm going to want and what I'm going to care about in 20 years. So it's not just inflation, but it could be things around your kids, et cetera. And his takeaway is basically just to build flexibility into your plan. So don't get it down to the last dollar of, well, this is exactly what I want to spend today. Therefore, my portfolio can afford it, and I'm going to pull the ripcord. And now, nothing else is happening. That there is some real value of just leaving yourself that flexibility to continue to mature.
Yeah, makes total sense. Totally agree with you there. Tad, this has been a wonderful conversation, and I really appreciate the value that you brought us here. Would there be maybe one or two different ways that our listening audience can, connect with you offline to learn more about what you're up to?
Yeah, two ways. One, I'm pretty active on LinkedIn, so feel free to follow me there, Tad Fallows. The other thing, if you check out our website, we publish a lot of our internal benchmarking, other research, so even non-members can download all of that free of charge. But if any of this seems interesting to you, whether it's getting access to some of these institutional caliber investments that we identify, or just the general community discussion, and again, no membership fees, if you go to longangle.com, you can click the apply button and we'd be excited to chat with you.
Yeah, that's great. Well, we'll definitely put those links in the show notes for the episode. Again, Tad Fallows, thank you so much for your time today.
I really appreciate you having me here.
Absolutely. And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.